Hi, I'm John Person from PersonsPlanet.com. With me today is Jay Hatfield from InfraCapFunds.com. Jay, welcome to the Las Vegas Traders Expo.
Thanks, John. Thanks for having me.
So let's tell the audience, which are live, about what you do and what you're looking at in the markets right now.
Oh, great. We have three income-oriented ETFs. One does pipeline companies. SEC yields about 10%. Another is an active preferred fund. SEC yields about 7.5%. And then a REIT preferred index fund yields about 6%. And actually, just in terms of the market, since you brought that up, we're relatively constructive about the markets in general. We think that loosening monetary policy, not just in the United States, but in all the BRIC countries, Europe's doing buying back bonds, is going to cause U.S. growth to accelerate next year into about the 2.5% range, which means that if you're a fixed income investor, you want to be more in spread products. So that's high yield funds, but also preferreds.
Okay.
So we think that those funds are going to act pretty well, and then also energy should do well. So risky stocks like, or more riskier stocks like financials, industrials, and energy could do well next year. So we think it's a pretty good market to invest in our funds, plus you get income.
Great. You know, this year has been very headline news-ish on the negative side. Everyone's been prognosticating we were going to go towards a recession. And so a lot of fund managers have been underperforming the market and more in defensive plays, your REITs, your utilities, staples.
Yeah.
So the trade has been less on aggressive growth, and it's been like literally no growth. No one wants to be a part of the Russell.
Yeah.
So you believe that maybe is that sector ready to catch up to the rest of the market?
We think so. What I think those analysts missed is that I think they were focused on the inversion. In the last 7 inversions since
Let's talk about that for 1 second. What I believe Jay is referring to is the inversion of the yield curve, the 2 to the 5, or the 10 to the 2?
Either one, or 3 months to 10. They're all kind of correlated. But what those analysts missed is in the average 10-year bond interest rate over those 7 recessions was over 7%.
Okay.
And what happened is housing got crushed in all of those recessions.
Right.
And we have the polar opposite situation. At the time when there was inversion, we had 1.5% 10-year. That's near all-time lows. People refinancing their mortgages. Housing market was actually ticking up. So they failed to look at the underlying cause of recession, which is pullback in housing, which drives consumer spending, because when you move is when you buy all of your furniture.
The ripple effect is phenomenal.
And
absolutely.
My father used to build houses actually here in Vegas. And when there's a recession, you lay off everybody.
Right.
You don't keep your construction crew around in your office, you lay them all off. So it's a very cyclical business that can drive the cycle. So those analysts weren't looking at that. So 3 months ago we were saying definitely no recession. Now we're saying acceleration because of this monetary policy. And so you'll see the last week people sort of agreed when the employment report came out. It was pretty robust. I used to be a utility investment banker, very overvalued. REITs probably overvalued. Consumer staples overvalued. They're getting smacked. And those risk sectors I talked about, financials, industrials, energy starting to rally. We think that trend's likely to continue. Obviously no guarantees, but if you play the odds and look at monetary policy, that would argue for an acceleration next year.
You know, to your point, a lot of people had suggested maybe midsummer when we started to see the Pulte home, not Toll Brother, but it was the Lennar, the D.H. Horton, when we started to see some of the bigger builders really accelerate, and there was some good technical undertone with volume, and the relative strength was outperforming the market. I think a lot of people missed that whole, or forgot what happened in the late 90s with the whole housing boom. What goes into a house? I mean, people get married, right? The newlyweds come in. The first thing that happens is you're not getting the big screen TV, you're getting the drapes, you're getting the right appliances. Then maybe you're getting the big screen TV man cave, and so furniture, right? And then finally you have that maybe empty garage. You need a car in there.
So drive spending,
And so that consumer spending, it doesn't happen overnight. It has a ripple effect that lasts probably
that's why
16 months.
It's a great indicator, a canary in the coal mine. Watch housing. Now, conversely, 07, 08, we're building 3 million homes. We need 1.4. That was a crash waiting to happen. So if but our housing market hasn't been, in this cycle, ever overheated. So we've had very sustainable recovery.
So in your funds right now, they're more positioned for cyclical growth?
Well, and we have this MLP fund, it's Pipeline Energy, that is forced to be.
And that's one of the most underperforming sectors right now. No one has respect for energy.
Normally they do better when it gets cold. It's getting cold in the east. So it's a pretty good cyclical trade. So, but it's not like we can really change the positioning there. The preferred funds we have higher spreads. And so higher spread fixed income is more sensitive to the economy or the stock market, so it's a higher beta stock market, and lower interest rate risk. So they should be relatively stable even in an improving market with slightly rising interest rates, assuming they don't skyrocket, which we don't believe they will.
Well, Jay, I concur with a lot of what you said, and folks, I would certainly encourage you to visit infracapfunds.com, because I think what Jay has to say would benefit a lot of investors out there who may not want to be like stock specific, but capture growth in the market. Thank you for watching. And again, Jay, thank you for joining us here at the Las Vegas Traders Expo.
Thank you.